Let us just get this out of the way immediately. No topic we will ever cover on this channel is going to make more people angry than this one. If you are a crypto true believer, you are probably already bracing for what you think is going to be a hit piece. If you are a crypto skeptic, you are probably hoping we are finally going to call it all a scam and be done with it. We are going to do neither of those things. Because the honest truth about cryptocurrency is that it does not fit neatly into either camp, and anyone who tells you it does is either not paying attention or has a financial interest in your opinion. What crypto actually is one of the most fascinating and genuinely complicated developments in the history of money and investing. It has created real millionaires and real billionaires. It has also destroyed real life savings and real retirements. It has produced technology that serious institutions are building on top of. It has also produced an ocean of fraud scams and worthless tokens that would make a Vegas casino blush. All of that is simultaneously true. And by the end of this video, you are going to understand the real technology behind it, why Bitcoin and Ethereum are fundamentally different from most other crypto, why the volatility is so extreme, what the legitimate bull and bear cases actually are, and how to think about whether any of this belongs anywhere near your financial life. Welcome to Better Investments. Let us start at the foundation, because most people who have opinions about crypto do not actually understand what it is at a technical level. And that gap in understanding is where a lot of bad decisions get made. Cryptocurrency is digital money that runs on a blockchain. So what is a blockchain? A blockchain is a ledger, a record of transactions. But instead of that ledger living on one server, owned by one company or one government, it lives simultaneously on thousands of computers all around the world. Every transaction gets bundled into a block, and that block gets added to the chain of every previous transaction in a way that is essentially impossible to alter retroactively, because changing any block would require changing every block after it across thousands of computers simultaneously. This is what people mean when they say crypto is decentralized. There is no central authority, no single point of control, no company you can call, no government that can freeze it. The ledger is maintained collectively by the network itself. Now, why does that matter? Think about regular money for a second. When you send someone money through your bank, you are trusting your bank to update their ledger correctly. You trust that they will debit your account and credit theirs. You trust that some third party is maintaining the record honestly. Crypto replaces that trust in institutions with trust in mathematics and code. You do not need to trust a bank. You do not need to trust a government. The math guarantees it. In theory. That is a genuinely revolutionary idea. The ability to transfer value between two parties anywhere in the world without needing a trusted intermediary has real implications for billions of people who do not have access to reliable banking systems. And it is why serious technologists and economists take the underlying concept seriously, even when they are skeptical of specific cryptocurrencies or the current market dynamics. Now, let us talk about Bitcoin specifically, because Bitcoin is the original, and it is different in important ways from almost everything that came after it. Bitcoin was created in 2009 by someone using the pseudonym Satoshi Nakamoto, whose real identity remains unknown to this day, which is either fascinating or terrifying depending on your perspective. Bitcoin was designed with one primary purpose: to be a decentralized store of value and medium of exchange that no government or institution could control, inflate, or confiscate. Its most important design feature is the hard cap. There will only ever be 21 million Bitcoin. Ever. That is baked into the code. You cannot change it without the consensus of the entire network, which has proven essentially impossible to achieve for fundamental changes. Compare that to dollars, which the Federal Reserve can and does create in essentially unlimited quantities. This scarcity argument is the core of the Bitcoin bull case. If Bitcoin is genuinely scarce, genuinely decentralized, genuinely resistant to seizure and censorship, and enough people in the world decide it has value as a result, then demand against fixed supply means price goes up over time. And the historical record so far, however short it is, does support that narrative. Bitcoin has gone from being worth essentially nothing in 2009 to tens of thousands of dollars per coin. Early buyers have seen returns that dwarf anything any other asset class has ever produced. Someone who bought $1,000 worth of Bitcoin in 2011 when it was trading around $1 would have had coins worth tens of millions of dollars at the peak. That is not a typo. That actually happened to real people. But here is the other side of that story, and it is just as real. Bitcoin dropped from roughly $69,000 in November 2021 to below $16,000 in November 2022. That is a 77% decline in 12 months. People who bought near the top in 2021 lost 3/4 of their money in a year. The crypto market in 2022 did not just fall, it collapsed. FTX, one of the largest crypto exchanges in the world, turned out to be a massive fraud. Its founder, Sam Bankman-Fried, was convicted of stealing billions of dollars of customer funds. Luna and Terra, two cryptocurrencies with a combined market cap of over $60 billion, went to essentially zero in a matter of days. Three Arrows Capital, a major crypto hedge fund, collapsed. Celsius, a crypto lending platform, collapsed. Voyager collapsed. Genesis collapsed. The contagion was enormous, and the people who got hurt were not just sophisticated institutions. They were regular people who had been told this was the future of money and had put real savings into it. So who is right? The believers or the skeptics? Let us build the actual bull and bear cases and let them stand on their own merits. The bull case for Bitcoin specifically goes like this. Digital scarcity is a new and genuinely novel thing. Before Bitcoin, there was no such thing as something that was digitally scarce. Digital things could always be copied. Bitcoin solved that problem cryptographically. If you believe that scarcity creates value and that the world will increasingly operate digitally, then a digitally scarce asset with a fixed supply has a logical foundation for value. The addressable market for a non-sovereign store of value is enormous. Gold currently has a market cap of around $15 trillion. If Bitcoin captures even a fraction of the role gold plays as a global store of value, the price per coin would be multiples of where it is today. Institutional adoption is real and growing. BlackRock, the largest asset manager in the world, launched a Bitcoin ETF in early 2024. Fidelity launched one. Pension funds have started allocating. When the most conservative institutional money managers in the world start building products around it, that is a meaningful signal. The halving cycle is a real structural feature. Approximately every 4 years, the rate at which new Bitcoin is created gets cut in half. This reduces the new supply hitting the market, and historically, each halving has been followed within 12 to 18 months by a significant price increase. This is not a guarantee, but the pattern has now played out 3 times. And finally, the sovereign adoption argument. El Salvador made Bitcoin legal tender. Other smaller nations have explored it. Even if the macro nation adoption story is slow-moving, any movement in that direction is demand that did not exist before. That is the bull case presented fairly. Now the bear case presented equally fairly. Bitcoin has been declared dead hundreds of times and survived, but the volatility is genuinely disqualifying for a significant portion of potential users. Something that drops 77% in a year cannot currently function as a reliable store of value or medium of exchange for most people. If you need the money, you cannot hold through a multi-year bear market. The environmental argument is real and unresolved. Bitcoin mining consumes roughly as much electricity as a medium-sized country. The proof-of-work mechanism that makes Bitcoin secure is extraordinarily energy-intensive, and in a world increasingly focused on carbon emissions, that is a legitimate regulatory and ethical risk. Regulatory risk overall is significant. Governments around the world are still figuring out how to deal with crypto. China has banned it. The US has been hostile to parts of the industry. The EU has implemented significant regulation. A coordinated regulatory crackdown by major governments could severely limit adoption and price. The narrative of crypto as a hedge against inflation and financial instability did not play out in 2022, when inflation was highest and financial conditions were most stressed. Crypto crashed along with risk assets generally. It did not behave like gold. It behaved like a highly leveraged tech stock. And the fraud and manipulation in the broader crypto market beyond Bitcoin is staggering. The number of projects that have been outright scams, pump and dump schemes, or just fundamentally worthless tokens with no real use case that captured billions of dollars in speculative capital before collapsing is almost too large to catalogue. This does not make Bitcoin a scam, but it poisons the well, and it makes the entire space harder to evaluate honestly. Now let us talk about Ethereum, because it deserves its own treatment and is genuinely different from Bitcoin in important ways. While Bitcoin is primarily trying to be digital money, Ethereum is trying to be a global, decentralized computer. Ethereum introduced smart contracts, which are self-executing programs that live on the blockchain. A smart contract does exactly what it is coded to do automatically, without any human intermediary. If condition A is met, then action B happens, automatically, every time, with no ability for either party to cheat, because it is enforced by the code on the blockchain. This enables decentralized finance, or DeFi, where you can lend, borrow, trade, and earn interest on crypto assets without a bank. It enables NFTs, which we will not spend too much time on, because the speculative mania around profile picture NFTs largely discredited the space, even though the underlying technology for digital ownership has legitimate applications. It enables DAOs, decentralized autonomous organizations, which are organizations governed by code and token holders rather than traditional corporate structures. Whether all of these applications ultimately create lasting value is genuinely uncertain. But the technology stack being built on Ethereum is real, and serious developers and serious institutions are building on it. Ethereum also switched from the same energy-intensive proof-of-work mechanism as Bitcoin to a proof-of-stake system in 2022, dramatically reducing its energy consumption by over 99%. That removed one of the major criticisms, and is a meaningful difference from Bitcoin. Here is the framework for thinking about crypto in your own financial life. 1. Understand what you actually own before you buy it. Bitcoin and Ethereum are fundamentally different from most other cryptocurrencies. Most altcoins are speculative bets on projects that may or may not work out. If you cannot explain what the token does, why it needs to exist, and why it will be valuable in 5 years, you probably should not own it. 2. Treat it as a speculative allocation, not a core holding. The people who have gotten hurt worst in crypto are the ones who put their emergency fund, their retirement savings, their kids' college fund into it. The people who have navigated it best tend to be the ones who allocated a small percentage of their overall portfolio that they were genuinely prepared to lose entirely, and then held through the volatility. The general framework most cautious financial advisors suggest for someone who wants crypto exposure is somewhere between 1 and 5% of their total portfolio. Enough to matter if it goes up a lot. Small enough not to be catastrophic if it goes to 0. 3. Buy through reputable, regulated exchanges and take your coins off the exchange. FTX taught the world a brutal lesson. When you leave your crypto on an exchange, you do not actually own your crypto. You own an IOU from the exchange. If the exchange fails, your crypto can disappear. Hardware wallets like Ledger or Trezor let you hold your own private keys, which is actual ownership. Not your keys, not your coins is a phrase that exists because people learned this the hard way. 4. Ignore the noise. Crypto Twitter and crypto Reddit are among the most biased information environments on the internet. Everyone in those spaces has a financial interest in the things they are promoting. The signal-to-noise ratio is catastrophically low. Make decisions based on your own research and your own risk tolerance, not based on influencers who hold the thing they are telling you to buy. 5. Zoom out on the time horizon. If the Bitcoin bull case is correct, it will play out over a decade or more, not over months. The people who have made generational wealth in Bitcoin are the ones who bought and held through multiple brutal bear markets. The people who lost money are largely the ones who bought into the hype at peaks and sold during the crashes. If you believe in it enough to own it, you need to believe in it enough to hold it through a 70% drawdown without selling. Here is the honest bottom line on crypto. It is not a scam. The underlying technology is real, and the problems it is trying to solve are real. Bitcoin as a decentralized, scarce store of value is a legitimate concept with a growing institutional foundation. Ethereum as a programmable blockchain enabling a new category of financial applications is a legitimate technology being built on by serious people. But the broader crypto market is also full of fraud, speculation, and worthless tokens wrapped in revolutionary language designed to separate you from your money. The key is knowing the difference. Going in with clear eyes about what you own, why you own it, how much you can afford to lose, and the emotional fortitude to hold through the periods when the whole thing looks like it might be going to zero. Because those periods will come again. They always have. And the people who survive them and come out the other side are the ones who went in prepared rather than excited. Next time on Better Investments, we are going into a world that almost nobody thinks of when they think about investments, but probably should. Art. The asset class of the ultra-wealthy. Is it a legitimate investment, or just rich people spending money on things they like and convincing themselves it is smart? We are going to find out. Subscribe so you do not miss it. And if this video finally made crypto make sense or helped you understand why to be careful, share it with someone who needs to hear an honest take. I will see you next time.